Understanding the difference between fixed and variable APR is critical if you want to borrow money wisely, whether it's through a credit card, a personal loan, a mortgage, or a business credit line. APR, or annual percentage rate, determines how much interest you'll pay over time. But not all APRs are created equal. Knowing how fixed and variable APRs work can save you thousands of dollars in interest charges and help you make smarter financial decisions. Let's start by defining APR. APR is the total yearly cost of borrowing, including interest and fees. It's not just the interest rate, it's the full cost of credit expressed as a percentage. When lenders advertise rates, they often showcase the APR because it gives you a more accurate view of what you'll pay. But you must understand if that APR is fixed or variable. A fixed APR means your interest rate stays the same for the duration of your loan or credit term. It gives you predictability, which is incredibly valuable for budgeting, especially if you're managing long-term debt like a mortgage, auto loan, or student loan. With a fixed APR, your monthly payment will remain constant, even if market interest rates rise. This stability is particularly helpful during times of economic volatility or inflation. On the other hand, a variable APR changes over time. It's often tied to a financial benchmark, like the prime rate, which is influenced by the Federal Reserve's interest rate policies. When the prime rate changes, your variable APR can go up or down, affecting your monthly payment. That makes it less predictable and potentially more expensive than a fixed APR. Variable APRs are more common in credit cards, personal lines of credit, and HELOCs, home equity lines of credit. While they often start with a lower introductory rate, they can quickly rise. If you're not careful, you could end up paying significantly more than you expected, especially if your credit utilization increases or your credit score drops. Let's say you open a credit card with a variable APR of 16.99%. That rate is attractive now, but it could increase to 22% or more if the prime rate spikes. And that means higher minimum payments, more interest accrual, and a longer time to pay off balances if you carry debt. Now compare that with a personal loan that has a fixed APR of 8.5%. You'll know exactly how much you'll owe each month, and that can help with debt consolidation, especially if you're rolling over balances from high-interest credit cards. Here's where it gets more nuanced. Fixed APRs are not always permanent. Some credit products advertise a fixed APR, but the terms allow the lender to increase your rate under specific conditions. This is especially common with store credit cards or subprime loans. Always read the terms and conditions carefully and watch for clauses related to penalty APRs, late payment triggers, or default rates. Likewise, some variable APR products offer a 0% introductory APR, especially credit cards. This is a promotional period where you pay no interest on purchases or balance transfers for 6, 12, or even 18 months. But when the intro period ends, a much higher standard variable APR kicks in. If you still have a balance, interest starts accruing immediately, and it can snowball fast. So which APR type is better? The answer depends on your financial goals and risk tolerance. If you value stability and predictability, a fixed APR is usually the safer choice. It's perfect for large purchases, long-term loans, or debt management plans. But if you're comfortable with market fluctuations and want to take advantage of low introductory rates, a variable APR may offer short-term benefits. Just make sure you have an exit strategy if the rate increases. Another factor to consider is your credit profile. Borrowers with excellent credit scores often qualify for the lowest fixed APRs and the most favorable variable rates. If your credit isn't great, you may face higher fixed rates or volatile variable rates, so improving your credit history, reducing credit utilization, and making on-time payments is essential. Let's take a look at how mortgage rates compare. A fixed-rate mortgage offers long-term predictability, ideal if you plan to stay in your home for many years. On the other hand, an adjustable-rate mortgage, ARM, which is a form of variable APR, may start lower, but can increase dramatically. These loans often appeal to buyers who expect to move or refinance within a few years. Business owners also face this decision. A business credit card with a fixed APR can simplify budgeting, but many prefer variable-rate business lines of credit for flexibility and lower initial costs. Again, the choice depends on your cash flow and how comfortable you are with changing rates. Let's talk about balance transfers. If you carry debt on a variable-rate credit card, you may consider transferring that balance to a card offering a 0% APR for 18 months. This can be a great way to avoid interest while you pay down your principal. But look for balance transfer fees and make sure you pay it off before the regular variable APR kicks in. Here is an often overlooked point. Lenders always clearly disclose whether an APR is fixed or variable. It's your responsibility to read the credit agreement and understand the rate type, index, and margin being used. For variable APRs, pay attention to how frequently the rate adjusts, monthly, quarterly, or annually, and what the rate cap is. Let's shift to auto loans. Fixed APRs are the norm here because they offer consistent payments, making it easier to budget. But as auto lending becomes more competitive, some lenders offer variable rate auto loans, especially for those with shorter loan terms or excellent credit. Again, weigh the savings against the risk of rising interest rates. Another critical area is student loan refinancing. Many private lenders offer both fixed and variable APRs. If you're close to paying off your student loans and want to save on interest, a variable rate might help. But if you're in it for the long haul, a fixed APR ensures your monthly payment stays the same. Let's summarize the pros and cons. Fixed APR pros: predictable monthly payments, easier to budget, stable during market changes, great for long-term debt. Fixed APR cons: higher initial rate, less flexibility, may have penalties or conditions hidden in fine print. Variable APR pros: lower initial rates, good for short-term borrowing, works well with introductory offers. Variable APR cons: unpredictable payments, can rise sharply with the market, riskier during inflation or Fed hikes. Ultimately, your choice between fixed and variable APR should reflect your financial habits, goals, and tolerance for risk. If you're carrying long-term debt or need consistency, fixed is probably better. If you're looking for a short-term advantage and are disciplined enough to pay balances off quickly, variable APRs can offer savings. Before you apply for any financial product, credit card, mortgage, auto loan, or student refinance, compare both fixed and variable APR options. Use online APR calculators, read the disclosures, and ask questions. And always have a plan for what you'll do if your rate goes up. Making informed borrowing decisions is a key part of financial freedom. Understanding APR types puts the power back in your hands. Whether you're managing credit, consolidating debt, or financing your next big move. If this video helped you make sense of fixed versus variable APRs, subscribe for more high-impact personal finance videos every week. Learn how to borrow smart, build credit, and protect your money.